Aloha, Marlo Peterson here, coming to you from the North Shore of Oahu, where I'm taking a little vacation before tax season starts. You know, I got here using frequent flyer miles. That's kind of like getting here for free. I love things that are free. That's why about half of my retirement income is going to be tax-free. Tax-free is the best kind of income to have. More on this in a little bit, because right now, I got to hit the waves. Aloha. So why tax-free? If my wife and I plan to have $10,000 per month when we retire, and our Social Security will be $3,000 per month, if the remaining $7,000 is all taxable, our tax liability will be approximately $1,350 per month. On the other hand, if only $2,000 of the remaining income is taxable and the other $5,000 is tax-free, our tax will only be about $50 per month. To make up the $1,300 difference with taxable income, I will need an additional $2,000 per month. In my case, the cash flow from $5,000 of tax-free income is the same as it is for $7,000 of taxable income. That's 40% more. That's a lot. And the more income you plan to have when you retire, the higher your tax bracket, and the more it makes sense to have a portion of your income be tax-free. There are more investment opportunities than there are people at this beach behind me. When it comes to tax-free investments, there's really very few. Most of you have heard of Roth IRAs and 529 plans. Well, those are full of restrictions. How much you can put in, if you can put anything in at all, when you can take it out, and what you can use it for. There's also in-state municipal bonds, but then the trade-off is very low interest rates and you're still subject to market risk. Another option is indexed universal life insurance, and I'll be back in a bit to explain how that works. How does indexed universal life, or IUL, work? Well, the IRS allows the funding of a permanent life insurance policy over just a few years, and they also allow for a very low interest rate assumption. This gives the policyholder the ability to contribute substantially more to the policy than is needed to cover life insurance costs. The extra funds can be linked to an index, for example, the S&P 500, but they are not actually invested in the index. When funds are linked to an index, they participate when the index goes up, but they do not participate when the index goes down. This allows the policyholder to capture the upside potential of a good market and protects against losses in a declining market. This gives the policy owner the ability to actually outperform the S&P 500 index. As the cash value of a policy grows, the funds can be borrowed at any time for any reason. These loans do not need to be paid back. At death, the policy will take care of the outstanding loans, and your beneficiaries will still receive a tax-free death benefit. There are really only a few good IUL products on the market, and these need to be set up so the policy owner gets the advantage, not the agent. We have only used 3 companies for IUL. All are A+ rated, and all have been in business for over 100 years. We also design each policy so the policy owner receives maximum results, even though that usually means less commission for us. As the sun sets on this video, make sure to ask me to run a personalized illustration for you so you can see exactly how indexed universal life insurance will work in your unique situation. Mahalo.